Hi, good morning, everyone. So today we will have our stock counter updates from Ascott Residence Trust, and then we'll have our macro and sector outlook for Singapore banks, Singapore Coal Monthly, US Weekly, China Weekly, and Singapore Weekly, as well as some technical analysis. Natalie will go through with you Ascott later. She's out on the meeting right now. So I'll jump straight to my Singapore Banking Monthly. So for this month's update, let me first talk about the loans growth. So loans growth is rather flat at 2.08, but it's an improvement from last month's 1.4%. And to summarize, mainly it's because consumer loans contracted for the second time in decades, and this is mainly due to persistent weakness in our housing loans that kept contracting as well. So from the chart here, you can see from the red line, it's our consumer loans. It hit below the 0% mark for the past 2 months. And as for our domestic business loans, it's still growing, but it's mainly due to our B&C, which is our business and construction loans. And you might think that why is B&C still increasing even though property cooling measures has been implemented about a year ago? This is because as the loans are drawn down progressively, the banks will still see this B&C growth over the next few months. So the reason why for consumer loans it's been affected is because of the housing loans contraction, and this is mainly due to the property cooling measures, which hit the retail side faster than the businesses, and also high interest rates as well. So for FY19, we expect loans growth to be rather slow and tepid around 4 to 6% for Singapore, and this in comparison to last year was around 7 to 11%. So this is mainly due to headwinds from the property cooling measures as well as slowing global trade and regional loans. So for the CASA, it has been contracting since September. It's been contracting continuously since September, while our fixed D, as you can see in the red line, has been surging, and it hit our highest growth in 12 years. So this is typical in a rising interest rate environment where investors usually shift their assets into higher yielding fixed deposits rather than leaving it in their current accounts and savings account. So in addition to this, there's this intense competition for deposits between the local banks as well as the foreign banks, and then as well as our Singapore savings bonds. So all this has also intensified competition for fixed deposits in Singapore. So with a higher proportion of fixed deposits in our banking mix, the cost of the funds for the banks rises because fixed deposits have a higher interest rate that the banks have to pay out to investors. So it's becoming more difficult for the banks to achieve their net interest margin targets. So for this year, NIM will have a rather flat growth for certain banks as well. So we expect competition for fixed Ds to probably taper off in the second half this year because of expectations of no more rate hikes, and investors are more or less pricing in that these few months the fixed D rates are probably the best that gonna get, since there's a rate cut that's going to be expected in the US as well. So for Singapore's interest rate update, our 3-month SIBOR is stable, while our 3-month SOR dipped 22 bips to 1.833. So as banks continue to compete for deposits by offering attractive interest rates and higher interest rates, this will more or less affect our 3-month SIBOR a little and kept it above the 2% mark, a level last seen during our previous Fed rate hike cycle between 2004 and 2006. So a pause in interest rate and the end of the interest rate cycle limits the upside for net interest margin expansion for the banks. However, we still expect the banks to have a stable net interest margin this year, and as well as some banks to deliver net interest margin improvements due to the lag effect of their loan repricing. But this year is around maybe 4 basis points for the banking sector as a whole for net interest margin improvement. And to compare to last year, it was around 9 basis points. So another thing new that I added in this quarter is the MAS monetary policy exchange rate management. So for the interbank interest rates in Singapore, it's mainly determined by the movement in the US interest rates, adjusted for the expected change in our Sing dollar and US dollar exchange rate. So domestic rates can be at a discount or premium to global interest rates when the Sing dollar is expected to appreciate or depreciate against other currencies. So a weaker Sing dollar and expectation of more depreciation will push our local SIBOR up higher. So even though LIBOR declined, as you can see from the light blue line, our SIBOR still rose, as you see from the dark blue line. So if MES adopts a dovish exchange rate policy, Singapore's interest rates may increase. And an update on SGX. So volatility is a very favorable backdrop for SGX because of the derivative business. So with increased volatility due to our trade uncertainties, the resurgence of trade concerns, geopolitical tensions, investors tend to hedge more. So SGX derivatives volume business will definitely benefit from heightened volatility. So we saw that in April and May comparison year-on-year growth for DDAV, which stands for your derivatives daily average volume, it grew 40%. Then as for SGX securities daily average value, it contracted negative 14% year-on-year. And for securities, it's not a surprise to us any longer. It has not been doing well over the last few years. That's why SGX has been increasingly diversifying into a derivatives business as well as FX and commodities. So our June figures expectation from SGX, we expect it to be better than expected, given the recent bout of global uncertainties as well. So we expect for Q19's results to be better than expected as well. So for Hong Kong interest rate, it shot up by 32 bips to 2.456%. And we expect higher interest rate to support the banking sector's profitability, especially for DBS and OCBC, because DBS has Tao Heng Bank and OCBC has Wing Hang Bank. And then for Hong Kong's loans growth, it recovered to 3%. April was almost non-existent at 0.5%. And Hong Kong's loans demand still remains cautious because of the high interest rates and lingering trade tensions as well. So to conclude, we maintain the Singapore banking sector at overweight because while the trade war affects investor sentiments in the near term, the bank's healthy fundamentals still remains intact. They do not have any asset quality issues and they are still able to deliver EPS growth on a sustained basis. And they are increasingly having better cost management with digitalization efforts, and low provision should also provide upsides to our ROEs. And the sector also provides attractive dividend yield of around 5%, and this will be supported by their strong capital ratios right now. So with the expectations of maybe one rate cut this year, we expect downside risk to net interest margin to materialize next year onwards because it also takes time for loans to be repriced to lower interest rates, given that it also takes time to reprice to higher interest rates. So net interest margin will probably be affected in FY20 onwards. So among the three banks, UOB remains as our top pick because of its exposure to trade war effects being relatively muted as compared to DBS and OCBC. So from this chart here, the dark blue line is UOB, and you can see that only 10% of their profit before tax comes from Hong Kong and Greater China, whereas DBS is the largest at 30%, 3 times of UOB. That's it for me. I'll pass on to Guangzhi for your coal monthly.
Okay, thank you, Ming. So next is the Singapore coal monthly update. Okay, so what happened over the past 2 months was that in China, the restriction on coal import still remains status quo. So especially for several ports like Fuzhou and in Fujian province and Qingzhou and Fangcheng port in Guangxi province, these 3 ports they extended the custom clearance for coal imports. So the average number of days delay increased by 10 days now. So in Indonesia, this is more important because the authority is proposing a higher royalties and early application for permit extensions. So according to some the market reports, the royalties on coal sales to central government will be increased by 1.5 percentage point to 15%. So previously was about 13.5%. Meanwhile, the miners are allowed to submit the permit extension up to 5 years before expiration. However, so far there is no timeline or specific day for the government to implement these rules. So we will keep monitoring the policy or regulation changes. Another bad news was that the the heavy rainfall happened in the first 2 weeks in June. So some producers declare force majeure on shipments in South Kalimantan. So the PLN, which is the National Power Corporation in Indonesia, estimated the coal supply could fall by 1 million tons in June within this region. So how we view this is that we think that the downward pressures from the public from the policy uncertainties will continue. At the moment, China's coal import restrictions mainly imposed on Australian coal, but these will pressurize the coal prices on the thermal coal market as well in Indonesia. However, the demand for the thermal coal from Indonesia grew by 46% in May. This was mainly due to the China power plant prepare for the summer season, which will start in June. So we can see that the stockpile actually increased by 23% in China as well. So and also the increment of the royalty rate will continue to weaken the profitability for those coal miners, because right now the miners are suffering from the thinner margin because of lower ASPs. So these 6 charts shows the current situations on the coal market. It is worth noting that the HPA, which is the coal price reference in Indonesia, dropped to the 23rd month low. So actually, in May, the coal prices continue to fall, and also the inventory level fell in May, mainly because most of the stockpile already shifted to the power plants. So right now the power plants have sufficient stockpile for the peak for the summer season. So next I'll pass on to Edmund to talk about US weekly update.
All right, thank you, Guangzi. So in terms of the US, for the past 1 week, we have seen most of the sectors return green. This is mainly because of the trade truce between US and China. But we think that the current stellar performance will likely fade because the PMI numbers are still down, and it is in line with the global the slowdown in the global economy. So today we'll be talking about Facebook. So we see 3 key drivers for Facebook's growth, and we believe that Facebook has yet to unlock its full earnings potential from Instagram. And with the continued monetization of Instagram and the renewed focus on video ads for the Facebook app, it will likely stabilize its monthly active users growth. And the addition of social commerce will be a meaningful driver in the long term. So currently, Facebook is trading at 25.4 times earnings, which is below the historical average PE ratio of 43. We think the valuation is attractive given its strong earnings potential and the continued monetization of Instagram. So the first point would be Facebook has announced that they're going to add an Instagram checkout function directly for Instagram, which will allow users to purchase directly from the app itself. So based on our estimates, e-commerce will likely add about $3 billion US revenue by 2021. But this is of course in the long run, and we don't expect it to be completed so soon. Next, we have the continued growth of Instagram Stories ads. So the number of advertisers for Stories ads have increased drastically from 2 million in Q4 2018 to 3 million in Q1 2019. And during the Q1 19 results, Facebook have claimed that the impression growth continues to be driven by ads on Instagram Stories. Last but not least, we think that the overhaul of the Facebook app to be more focused on family and groups instead of public feed will likely improve their machine learning and that will allow them to improve their ad targeting function. And also, we think that the new pivot towards stories feed for the Facebook app is consistent with the current consumer preference for video feed. And given that social video ad spending is estimated to grow about 44% through 2021, we think that it is positive for Facebook. So this is the list of upcoming earnings results release. And the banks are going to release their results next week. And with that, I'll pass on my time to Jie-Yuan, who will talk more about the China sector.
Thanks, Edmund. I will give the update on the China banking sectors. We are thinking there is a high possibilities the PBOCs to cut the required reserve ratios on the third quarters. From the chart, we can see the purple line is the matured medium-term lending fund. The MLF is the tools the PBOC to use to boost the liquidities. We are seeing there is a huge amount of the MLF will be matured at the June, July, and August. And from the previous the PBOC cut the triple R rate, the part of the use of the fund released by the triple R rate cut is to pay back the medium terms the leading fund. I think for the benefit PBOC's cut the triple R's for the banking sectors, we're thinking it will save the interest expense because the MLF's the interest rate is 3.3%. It will save the interest expense for banks about 23 billion RMBs. Also, the rest of the money is to boost the liquidities for these banks. Also, with the core tier 1 asset and the ratio still remains very high, there are still enough rooms for China Bank to prevent the risk. So we are positive on the China's banking sectors. For China last week, because of the temporary truce between China and the US, there is the beginnings on the stock market. But because of the China side said last two Thursdays, if there is going to reach the deals, the US side must remove the existing tariffs. It adds the more difficulties to reach the new agreement. So in this circumstance, we still for the stock recommendations, we're looking for the stocks with long-term revenue guarantees and focused on the local demand. For this week, we are waiting for the China's inflation numbers like PPI number and the CPI numbers. Also to see the import and export numbers to see the trade situations of the China. And I will move on to Paul for the Singapore Weekly.
Thanks, Jen. In terms of for our weekly update for Singapore. In terms of the macro, again, things are still. I mean, not to beat the dead horse here, but anyway, things are still weak. I think the latest PMI number for June was the lowest in almost 3 years. So we still see the deceleration in manufacturing activity. Secondly, I mean, these are all the latest data points out from Singapore with some of the tourist arrival numbers also trending down. Probably about 2% in the second quarter. As you recall, last year was a good year, it was almost 6%. Last year was 6%, it grew 6%. So this year probably trending around 2%. In terms of the US macro, I think the main one was of course the jobs data. And I think the positive was wage growth was kind of stable at 3.14%. So no upward pressure on inflation. In terms of global macro, I guess the main one is I think a couple of weeks ago where you should expect another QE from the ECB. Okay, in terms of our tactical views, I think the main talking point for macro-wise would be, of course, whether the Federal Reserve will cut rates. I think we should expect one rate cut at least by the end of July. There's a FOMC meeting 30th, 31st of July. The reason we say that is because in last month, there was actually a press conference by Jerome Powell. So I think his key point was that I think there are at least 2-3 reasons why he thinks there should be a rate cut. Firstly, global growth is weakening. And secondly, he's explicitly mentioned that there should be some insurance or even a preemptive cut. It's so-called, I quote, like prevention better than cure. So that means that they're willing to do a preemptive cut so that to prevent any prolonged weakening in economic growth. So that's the second reason. That's the first reason. The second reason is, I think, inflation is below their target 2%. So that gives them another reason for rate cut. And third one is, even though unemployment numbers are strong, unemployment numbers are actually a lagging indicator. So we think that at the very least there should be at least one rate cut by end of this month by the Federal Reserve. In terms of our view, we still think maybe we still expect some sideways movement from the market. So we kind of we expect to at least fade your positions, at least as we get into this so-called G20 kind of rally. In terms of our recommendations, we still favor financials. I think the results, the second quarter results for the Singapore banks should be strong. A couple of reasons for this. Firstly, the interest margins, as Ming highlighted, should still be healthy. As you know, the repricing of all the loans, there'll be some lag impact. So that's number one. Number two, while loans growth is tailing off, it's still a low single digit, so that's within expectations. And the third reason is the big rally that we see in the bond market, especially from the US, should help the Singapore banks, at least in their trading income. So these three things should at least give us a strong, at least a healthy second quarter results for the banks. Likewise, for the SGX, the strong derivatives volume, although equities is weak, but half the business comes from derivatives, is probably going about 20-30%. So that should help the SGX results. In terms of weeks ahead, I think there'll be some Powell commentary. Then for Singapore, on the 12th of Friday early morning, they probably release their GDP at probably going to drop to less than 1% growth year on year. And of course, the big one will be the FOMC meeting end of this month. Just quickly, just some on the charts, just to show the extent of how things are slowing down. This is the PMI numbers for Singapore. Again, the visitor arrivals, and of course the global PMIs that came up early Monday. Everything globally is still trending down, at least on manufacturing activity. This is the payroll numbers, but the key one is the red line. We do not want to see any excessive move on this. Otherwise, it would stroke inflation fears and probably make the Federal Reserve dial back. But so far, it's just been trending sideways, about 3.1%. Okay. Anyway, that's it. I'll move on to Weiren on the technical.
Thank you, Paul. So for today, I will share with you two charts, Bank of China and then Dow Jones Industrial Average and Transportation Index. So for Bank of China, we are looking at a gloomy outlook because we are in a prolonged range period from March 2015 until June 2019. So for this, why we are looking at a potential further downside is because bearish engulfing candle at a $4 psychological resistance level. So this gives us a strong bearish expectation. And also another key factor is for downside toward 3.27 is the Fibonacci expansion of 4.85 high to 3.41 at this 118%. So therefore, if should price level fall to this price level, we believe there might be a further upside over at this level. So next, I'll move on to Dow Jones Industrial Average and Transportation Index. So for Dow Jones, we are looking at the expanding triangle still in fourth. So our view is still the same as the sharing session on last month on the 10th of June. So for Dow Jones Industrial Average, the market actually play out accordingly to our sharing. So if you do remember that my sharing that I share that price might have a strong rally upon hitting 38.2% or either 61.8%, but the latter come through over here. So now we are looking at the immediate resistance at 27,000 as 2672.4. The previous high over here at the B is broken. However, point of evaluation of wave D is still need to be monitored. Should price break up 28,000, which is around 1,000 point off wave D, we might be looking at 30,000 for Dow. So right now we are using Dow theory to predict whether there's a upcoming recession. So based on the key important factor in Dow theory, the divergence has happened. between the transportation index and the industrial average. So the top is the transportation index, the below chart is the industrial index. So unless transportation index broke out of the diamond top, broke up higher and reached 11,000. Otherwise, we still maintain that Dow may be topping out at 2749.1 over here. And should Dow top out over here, there might be a three-way correction down to wave E at 21,000. So based on the divergence in history for the past century, wherever there's a divergence happen, recession always happen.
So sorry, we actually still have one more segment. Today I'll be talking about the proposed combination of Ascott Residence Trust and Ascenders Hospitality Trust. So this was proposed last Wednesday, and so a little bit about the deal metrics. The conversion price is based on the net asset value of respective trusts at the most recent valuation date. So that gave us a conversion ratio of about 8.4 times and an implied share value of one AHT share, $1 and about 9 cents, 109 cents. And this implied share value is actually a premium to NAV and also the respective closing price and VWAP, as you can see on the table over here on the left. So this consideration will be paid 5% in cash and another 95% in units. So that will be about 5.43 cents per AHT stapled security and about 0.8 Ascott shares. What this means for AHT shareholders, on the positive side, the combined entity will have a enlarged asset base. It will be bigger by 33%, and this leads to a gross profit to increase by 36% and DPU accretion of 2.5%. On the same day, on the same Wednesday, actually FLT also announced the acquisition of 12 assets that will increase the asset base by 22%, but that will only lead to a DPU accretion of 1.1% for FLT. So what I'm trying to show you here is that this 2.5%, it may seem small, but it's actually quite significant in comparison, in context. So the enlarged entity will have a larger debt headroom that will allow them to acquire more assets. So this additional 120 million will equivalent to about maybe two more assets. And there will be the free float will increase by 50%. This is actually because for the combined entity, the number of units held by CapitaLand will be reduced, hence increasing the free float. And what this does is it helps facilitate the index inclusion into the NARI index. And so basically the free float is actually one of the criteria for inclusion to the index. The most recent REIT that was actually admitted to the NARI was FLT also, and then we saw an increase in share price by about 10.9%. This is after inclusion into the index. So if ART gets included to the index, we could potentially see some sort of price increase. Okay, on the negative side, due to the overlap in geographies, namely Australia and Japan, there will actually be an increase in concentration risk for the top 4 geographies, and it increases marginally from 47 to 51%. So I think what we have to note is that Australia and Japan, they are actually soft markets. We need to say that the supply coming onto the market is relatively high, about 20 to 30%. That might actually lead to pressures on the average room rate. A mitigating factor is that all six of the assets in Australia, they are under management contract, so their revenues are actually variable, whereas the 5 hotels that are added in Japan, they're under a master lease and they have a minimum base rent with a variable component. So this allows them to capture a little bit of upside from the events that are happening in Japan, namely the 2019 Rugby World Cup and the 2020 Olympics, while remaining protected by the fixed rents post-2020. Okay, so that's all for me. We'll open up for questions again.
Thank you, Bill, for a question. To answer that, just now I mentioned that key price target level of 27,400 for Dow must be hit, and whether will Dow Transportation Index break out of the diamond top. So if Dow Transportation do increase by this week and break out of the diamond top, trend line. So then the divergence we might not see. Should there be a divergence, then the time frame will be around another 6 to 8 months. Thank you.
So we have a question about what is the risk of this M&A not going through in relation to the ART-AHT combination. So for this combination to be approved, to be passed, it first of all needs to be approved by shareholders. This will be done at an EGM conducted sometime in October for both the trusts. And it requires a 51% plus 1 majority vote for both, and an additional requirement for SNS Hospitality unit holders is that it has to be more than 75% votes for AHT for this to be passed. So what I'm saying is that both sides need to have a majority vote in favor of this combination, and it will be passed, if successful, it will be passed in December. Yeah. So as you can see from the previous slide, so for the AHT side, I think that most of the unit holders of SNS Hospitality Trust will be quite happy because of the premiums. So I don't think that there will be any issue of getting approvals for AHT. On the ART, for the ART unit holders, it really depends on whether or not they feel that this combination is beneficial for them, or if they feel that they can get a better yield elsewhere. But for this deal metrics, I think that 2.5% increase in DPU is fair. As previously mentioned, it increases the AUM by 33%, and in comparison to FLT, which acquisition of 12 assets, which will increase the AUM by 22% and only lift DPU by 1.1%. So this is considered it's considered okay, fair. Yeah, this really depends on the ART side of whether or not they will approve this combination. Hi, so we have one more question about whether or not there will be more mergers to come given this ART-AHT combination. Yes, there is a combination that has been proposed. To answer that question, I think this is a harbinger of what is to come. Yes, and in the works, there's actually also one more proposed merger, which is the OUE Hospitality Trust and OUE Commercial Trust merger. And what we're seeing is that also ESR has a 5% stake in AIMS-M, so that might also lead to further consolidation. And so we think that one of the reasons that there is more combinations or mergers is because there's a glass ceiling that is tied to the size of the REIT. So REITs that are smaller size, are below 1 billion market cap, they actually face more difficulty or unfavorable rates when it comes to borrowing. And I think and with the enlarged asset base, they are able to secure more favorable terms. And also, if there are synergies that can be reaped, then the merger or the combination will actually make sense. Okay, thank you everyone. Thanks for tuning in today. We'll end our webinar here.